Markets have a habit of stampeding in one direction only to turn around and run just as furiously in the opposite direction. It's reflective of these macro and financial cycles, but also reflective of social and crowd psychology cycles. And I think one of the best illustrations of this is the long-term relative performance chart of value stocks versus growth stocks, which is what we're seeing on the screen here. And so, just a point of clarity, if that line is going up, that means that value stocks are outperforming growth stocks, or it could be simply that growth stocks are underperforming value stocks. And when it's going down, that means that growth stocks are beating value stocks, or value stocks are falling behind. So, for instance, during the dot-com bubble, we saw value stocks tremendously underperform growth stocks during the tech bubble. And then into just pre-GFC, we saw that subprime credit bubble and commodity supercycle, aka bubble, culminating in value really clawing back all that return and then some against growth as they benefited from that trend, only for that to then unwind. And in recent years, it was kind of like tech's second coming, and value stocks were also the initial losers of the pandemic. Whereas now they're actually starting to become the winners because if you look at what's going on right now, growth stocks are suffering because the tech stocks, they're finding it hard to repeat those sort of one-off gains that they got from the pandemic, and it's also hard for them to repeat the gains that they got from just that mass adoption or quick adoption phase and market share eating phase. It's really hard to actually replicate that ongoing. So that's the growth side of things, but on the value side of things, the commodity-related sectors are getting a boost from higher commodity prices. Financials are getting a bit of a boost also from higher bond yields. And meanwhile, the defensive side of value is also getting a boost, understandably, in these uncertain times. And that's your consumer staples, utilities, healthcare. And so, if we look at this chart here and think about that earlier statement about these these cycles and these macro psychological cycles, it's quite easy to see how this, that could be the turning point on this chart, and it could be that we've still got a ways to run because these things do tend to be multi-year in nature, and once you do get a major turning point like this, it's quite rare that it would be just a bounce and then back down to its ostensible trend of the previous few years. And I think zooming out, it does quite clearly look like a mean reverting cyclical thing, and especially if we think about those comments around the macro psychological cycles, it's growth stocks, tech stocks could be still in for a few more years of underperformance. So if you liked this chart and you thought this was interesting, you can go and see the original post. It was the from the bonus chart section of the weekly S&P 500 chart storm. I'll put the link to that in the description and the comments so that you can easily pick that up.